I want to take a moment to just go over some math and take a look at what it takes to get to, say, a 100% return, and look at a few ways to get to a particular return. And just what I want to contrast is a few things. One, how losses work against you and how they make things so much more difficult, and how volatility, is really your enemy. And also on how, you've got time if you're patient and you wait for the right opportunity and you're able to put down, a decent return when the opportunities are available. Remember, to put down an annual return, you have 12 months. It's a long time, all right? And it may not seem that way, but it is a long time to put down that return. And that's one of the things that I've been very good at, is being very patient and disciplined. And when I won the US investing championship in the 90s, that's really what paid off for me, because in the very beginning, in the first quarter, I was only up about 8%. And I think first place was up. I can't remember if it was 50, 60, or 80%. It was way, 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 5 or 10 times more than me. And then even in the second, we got to that second quarter, halfway through the year, and and I still was way behind. It wasn't until the third quarter where I took the lead, only by a little hair. We were basically neck and neck, and in the fourth quarter, I pulled away and finished double the second place. So, and it was 155% return, and I started off with just an 8% return. Now, the thing I want to point out, and you're looking at these numbers, probably saying, "What the heck is going on here with these numbers?" Um, so this top here, just think of these as think of them as trades or as months. All right, we'll think of them as months first. So think of this as 6 months. Now, in between those months can be a month off, or it could be 6 months in a row. It could be 6 months. Uh, you didn't do any trading and then you traded 6 months in a row. Doesn't really matter. It also doesn't matter what order that these returns are in, because we're compounding. So, but let's just do them in the order that they're in. And let's just say in month one, you're up 20%. Now, that's how much I was actually up for the month of January, and in the US Investing Championship. Now, month two, you're up 30%. What that would do is that would get your account up 56%. If you were up 20% in the first month and then 30% in the second month, you're now up 56%. Now here's the secret. Um, once you put down a decent return and you're able to wait for that nice moment where you get the pitches come across your plate, now it gets progressively easier, because compounding really works in your favor now. Now, let's say the next month you're up 10%. That pushes you up to 71%. Now, let's say next month you're up 5%. That pushes you up to 80. 5 more percent, 90, 5 more percent, you're at about 100%. So once you're up, and this is sort of my plan for the US Investing Championship, is to really try to make as much as I can when the opportunity is there, whether it's short-term trading, whether it's playing breakouts for bigger moves, uh, trading around positions, whatever it is. I want to try to maximize the opportunity when it's on the table, and then do nothing and really just wait until I'm able to get another opportunity. And the thing is, once I'm able to do that, I only need much smaller opportunities now. They get progressively smaller and smaller. Now, let's contrast that. Let's take a look at, and again, remember, it doesn't matter the order. You could start off with this particular trader, we'll call it trader B, if you will. Oops, and that moved out. I don't know how that did that. Hold on. With this trader starts off down 25%. So obviously down 25%, you're down 25%. $100 would be worth $75, right? So, and again, if you started off up 100%, it would be the exact same numbers. But this trader is starting off down 25. Now up 100% the next month. All right, well, that only puts you up 50%. See, because you were down 25%. See how losses work geometrically against you? Once you're down 25%, now a 100% gain, instead of putting you up 100%, only puts you up 50%. So now let's say the very next month, you're up 50%, which to be up 100% one month and 50% the next month is probably pretty difficult for most of us, right? I've had some months where I was up 100%, but they're very few. Um, now, so this is a really an optimal situation. Now, 25% down in the next month would bring you where you're only up 69% now. See how you give back so much being down just 25%. Now you're up 25%. Now we just swap up 25%, down 25%. You're up 111, down 25%. You finish only up 58%, about half or 60% of 58% of this trader here who never had those big returns, but never had any drawdowns either. Now you might be saying, well, there's no down months here. Okay, that's fair. That's fair. However, this is only 6 periods. Okay. You may not you may be able to find 6 periods where you're able to do this and you don't have much of on the downside for down months, and you may find 8 or 10 periods where you're able to do this and have 5% months and you only have a couple percent down months here and there. It's just illustrating the power of compounding, and also you have a bigger month, you may have a bigger month than 20%. Now again, this could be a stock or stock trades. You put all your money into one stock, um, then or then you would have this would be your ROI. If you did stock one up 20%, your second position was up 30, 10, 5, 5, 5, you'd be up 100% return on investment. So it works regardless. Like I said, these are just periods. It doesn't have to be months. It could be days. It could be weeks. It could be stocks. So when you start slicing and dicing these numbers, I mean, you can play with these numbers as much as you want. You will never find a situation where wide swings up and down in your equity work out better than consistent performance. You're much better off to have very consistent small performance than having huge performance but having big drawdowns. And again, I've messed with these numbers not only scientifically and in every way, shape, and form that you can possibly think over almost 40 years of doing this, but also over 37 years of trading. I've also gone through these numbers in my own personal trading, and I started off with the wild up and down wild swing version for the first 5 or 6 years and got nowhere and made no money whatsoever. And then when I went to the more consistent version, that's when I hit it out of the park and didn't have a down year from that point going forward. So again, just want to illustrate this. Try to get the key is to wait patiently and to wait for that pitch to come across the plate, and to really, and again, if you can start this way, you can start in reverse. If you're just putting down little 5% returns here and there, you start building that cushion, right? And now if you get even one or two good months or two good stocks, you're now going to catapult yourself, to a big return very quickly. So it works in reverse too. So keep that in mind, that while the market's moving up and you don't have any stocks and you're sitting there twiddling your thumbs, or you don't see setups, keep in mind to be patient, keep in mind the numbers, and that you don't have to get this big giant winner all at once. You don't have to be right every single trade, every single day, every single month. You need a handful of decent performances, and that will put together that big return. That big return can be made with some relatively smaller returns, and that's the power of swing trading. The reason why swing trading is so incredibly powerful is because you can put together an average gain of 10 or 15%. May not sound like much, but when you compound that against, say, maybe an average loss of 5%, you have so many opportunities throughout the year. There's always, or almost always, these opportunities. Virtually every month or two, or every 3 months, every quarter or two, you're going to have a bunch of opportunities to take advantage of. Where if you're relying on a big giant move, you're only going to have very few opportunities to do that. usually at the beginning of a bull market, at the end when everything's blowing off and you get lucky and you happen to stay in the stock and go through that climax run, which I don't know too many people that can, and then you get out right at the top before it comes crashing down. It's there's some big challenges to nailing down those big moves and to getting those big moves, and they're so infrequent, but you can very frequently. And that, now again, you could say, well, then why not day trade? Well, there's an argument for that too. I mean, that's another way to do it. Day trading, it would be compressing this down even more. Now your gains and your losses are very small; they're microscopic. But now you're doing thousands and thousands and thousands of trades, and you're turning over that edge again. So the bottom line is that the smaller the numbers, the more you need turnover. So turnover is good as you get smaller and smaller numbers, right? You have to turn that over. The key is to maintain that edge. The key is to maintain buoyancy and to make sure that you're not getting yourself into big trouble. Don't worry if you're keeping yourself, if you're flat and time is going by and the Dow is hitting new highs and you're not going anywhere and you're not doing anything and you're waiting and waiting. Don't even worry about that. What you want to worry about is getting in the hole, especially deep in the hole. That's what kills your performance. That's what kills your confidence, and that's what will make you quit, and that's what will make you end up with an average performance at best. So just wanted to point that out. I don't, I hope this is helpful. And again, I'm going to try to demonstrate this as best as I can going forward, with my own trading, and we'll see. We'll see how things work out. All right. Talk to you guys later. Bye bye.